At the centre of the inflation debate is whether the inflation we're seeing is transitory in nature. Are these one-off rises, or are they the beginning of a series of increases? Are they due to bottlenecks and supply chain disruptions, or will inflation become stickier in measures such as wages and housing? Robin Marshall runs us through a number of different inflation angles.
Well, when you look at the CPI, Roger, it's notable that we've had big jumps in items which appear to be linked to sort of semiconductor prices and the sort of shortfall of global sort of semiconductor supply. So if you look at the US CPI breakdown, you'll see used car prices suddenly surged sort of 10% in April, and that followed a 0.5% increase in March. And the reason for that was, of course, there are less new cars being made, so demand got reallocated to used cars. Hence, we have this huge kind of one-off price surge in March, April. I mean, that's the biggest since they started compiling the index in the 50s, that surge in April. And then if you look at elsewhere, you'll see, energy prices are up sort of 25% year on year in the index. So those kind of look like very much kind of transitory inflation impacts. And you've got that alongside that, you have these big base effects. Remember that in the February to May period of 2020, when COVID hit, the CPI dropped about 1%. So, even if prices had stayed unchanged, for example, in April, we would still have had a big surge, sort of 0.8 year on year. So there are those base effects are working very much to drive inflation up at the moment as well. When you look at what might be more persistent inflation gains or price gains, you could argue, I think, that house prices are showing some signs of a more genuine uptick, and that's reflected to low inventory in housing and the housing crisis, frankly, that never was. Because if you remember, during the early stages of COVID, people were reading off the GFC playbook and saying, "Oh, we're going to get another housing crash." Well, of course, it's a very different housing market now than it was then. We have a shortfall of housing supply. So you could get a little bit of pressure there, and that creeps through into the rented sector as well, where you've got this big owner equivalent rent sort of housing component in the CPI. But overall, I think there are reasons for thinking that the bulk of these moves are transitory. And as we go into the summer months, get beyond those big base effects, which should be later on in the third quarter, you're going to see the CPI stabilise, particularly if energy prices also stabilise.
Currently, the Fed thinks that this inflation will be transitory. But the Fed have been reactive rather than proactive over the years. So therefore, investors will understandably be wary that policymakers could do another U-turn if the inflation data stays persistently strong.
In terms of the signalling we've had from the Fed, Roger, it looks as though we're going to need probably, I would say, two or three things, but principally they've talked about a sustained improvement in the economy and indeed a sustained increase in inflation and inflation expectations. And, 1 or 2 months data just isn't enough. A sustained improvement in the economy is a big part of this, and indeed sustained increase in inflation. And remember, of course, they've moved already as of last summer to an average inflation target of 2%. They're prepared to accept what they deem to be temporary inflation overshoots. We don't have any time period, incidentally, on how long is temporary. The related variable, I think the other key variable to look at is the labour market and how far the tightening of capacity in the labour market starts to affect wage settlements. And again, I'd signal there that at current unemployment rates, we're not far away from twice the sort of 3.5% unemployment rate that we saw pre-COVID. So we're still miles above sort of full capacity in the labour market. And if you look at other measures like U6, underemployment, we're still a long way away from full capacity. So there isn't any sign yet, I think, of any type of genuine cost push inflation coming from the labour market. And I counsel a little bit of caution too in terms of average wage settlements, because there's been a bit of a statistical effect pushing up average hourly earnings with some of the poorest paid industries, the ones that were hit hardest in COVID. And with those job losses, that distorted average wages upwards in sectors like retail, hospitality, leisure, and so on, where those wage settlements tend to be lower. So overall, I think those are probably the two key areas to look at: how long this persists, this inflation overshoot and economic growth recovery, and again the tightening. How far there is genuine tightening in the labour market? Are we approaching some notion of full employment? And we seem some distance from that at the moment.
Many investors remember the taper tantrum of 2013 when the Fed started to rein in their QE programs and found themselves repeatedly having to dial back their intentions because of an adverse market reaction. Investors are again concerned that the Fed may wrong for the market, although the market setup today may be very different from 8 years ago.
Very much so. This is a different setup. I mean, and the lessons, you might argue some lessons have been learned from 2013. There are people doing a kind of Kahneman System 1, jumping to the conclusion that a genuine inflation process is now developing. I mean, I think that's not based on anything genuinely fundamental. We don't see evidence of tight capacity or labour market constraints, the type of factors that drove big inflation numbers in the 70s, 80s, 90s, and so on. So the bond market so far, although yields have been backed up, of course, from the sort of post-COVID lows in the sort of 50 basis point region in the 10-year, and we're now well, above 1.5. The market, I think, took the Bank of Canada taper in a pretty mature fashion when that was announced in mid-April, hardly reacted. And I think there's a realization the market's already priced in a decent growth recovery now and these higher inflation numbers. So actually, I don't think the taper reaction will be as marked and as extreme as the one we saw in 2013, because the markets also realize that if you look at QE and Fed purchases, although it's clearly an important variable, there have been periods since QE was started in 2008-9 when yields have fallen. The yields fell when the Fed wasn't doing QE, and similarly yields increased when the Fed was doing a lot of QE, as we've seen the last 6 months. So for that reason, it's not a dominant variable in driving yields. And I think the market realizes the growth inflation outlook is the key, as it's always been. And we've already priced in a significant V-shaped recovery, and indeed quite high inflation rates. If you look at break-evens now, above 2.5% in some areas. The break-even curve, incidentally, is a little bit inverted, which suggests, the highest inflation break-evens are in the shortest maturities, which suggests that market fears are more about short-term inflation pressures and expect those to ease over time.
Although these are very unusual times for both the economy and financial markets, it could be that much of the drama for bond yields is actually now behind us.
It's a good point in that regard, Roger, as to whether or not we've seen the bulk of the increase in yields and indeed curve steepening that's gone with it since sort of the middle of last year, the sort of bear steepening of the curve that we've seen. I think you could make a case to say that fiscal policy and the scale of the Biden stimulus programs are a factor that could lead to a bit more curve steepening, in the next sort of 3-6 months. However, when you look at what's already been priced in on growth and inflation, you've still got the issue of those numbers being delivered And what we know pre-COVID is that the US economy and indeed the global economy was not that strong. And there are forces of secular stagnation still in play. So I find it hard to see how yields can re-enter a kind of the old regime, if you like, the sort of pre-GFC regime that some people are even talking about on the back of this policy stimulus, because that has to deliver stronger growth. And we've seen since the GFC over 10 years of QE on and off from the Fed, and that's never really succeeded in delivering the kind of growth inflation numbers that people seem to be scared of still. So for that reason, the worst of the drama, may already have played out in terms of how far yields back up.
So it's clear that the inflation debate will rage on. The view that inflation remains higher for longer is based on the ongoing fiscal stimulus colliding with supply chains that have so far been unable to adjust meaningfully. The less dramatic view on inflation is that the bottlenecks and base effects will pass, and that it will take a long time for jobs to fully recover and put upward pressure on wages. The market fears a taper tantrum and expects that yield curve control will be implemented by central banks. But it may be that the best of the growth surprises are coming out right now and will have passed us by the second half of this year.